Okay, we'll kick off now. Hi everyone, my name is Jane Arana and I'm an analyst at Quoted Data. Welcome to the second day of our annual ESG conference. For those just joining today, we kicked off yesterday with our Environmental Day with opening remarks from ESG Clarity's editor Natalie Kenway and Julia Dreblow from SRI. Today we're starting with our Social Day. And we have three very special guests. We have Ben Ritchie from Dunedin Income Growth, Paul Bridge from Civitas Social Housing, and Simon Chisholm from AM Resonance. So we'll start with Ben Ritchie. Ben, how do I unmute you? Hi, Ben.
Morning.
Hi, how are you?
Yeah, not too bad, thank you.
Good. Thank you very much for joining us today. It should be.
Oh, no, thank you for having me.
Great. So yeah, for those who tuned in yesterday, the format today will just be presentations from our guests, and then we'll kick off with Q&A. But please feel free to enter questions into the Q&A box as we go through the presentation. Great. So Ben, if you just let me know when to change the slides, and then we'll go from there.
Yeah, that would be great. If you could just skip on to the opening slide, that would be great. And maybe just make a few remarks. Apologies, I've got a bit of building work going on next door, so if you hear any banging, that's not me hitting my head against the iPad. That's the builders next door. So sorry about that. I think just worth saying to start with that Dunedin Income Growth is I guess comes from a history of being a sort of traditional UK income growth investment trust with a focus on delivering yield, growing it in real terms, and looking to deliver attractive total returns. That's the DNA of the trust. That's what it's been doing for 30 or 40 years. But it's also worth saying that this trust goes back an awfully long way. It was founded back in 1872 in Dundee, and it's been around a long time, and it's been through a lot of different iterations in that time. Originally, it was founded to finance railroads in North America in the 1870s, and over that time period, it's been through doing a lot of different things. And this year, the board has decided to incorporate sustainable and responsible investing criteria as part of its investment process, and that makes it one of the very few. I think it makes it the only income-focused investment trust that has that from an equity perspective, and I think one of the very few equity trusts that has that overlay. That doesn't mean that ESG is the only thing which we're looking to do, but what it does mean is that it's something which is formally incorporated into our approach and principles. It builds on what we would have as a sort of normal integrated approach, and I think hopefully it gives investors confidence that we're looking to manage our risks on the downside, but also looking to take advantage of the opportunities that present themselves in the marketplace as well, whether that's to invest in very strong companies, companies that are providing real solutions to some of the global economy's biggest challenges, or companies where we can engage with them to drive real change. Thinking around the social aspect of ESG, I think in many ways, and I've been working in equity markets for nearly 20 years now, I think that the social aspect of investing is probably the least developed. Certainly governance, if you think about the three components, was certainly the first area to receive a lot of attention from investors. And certainly as long as I've been doing this, we've been very focused on governance. I think over the last 3 or 4 years, there's been a sea change in terms of investors' focus on the environment. But I think social aspects and the ability of companies to drive change in that area has probably been an underdeveloped area. But it is an area where I actually think that individual companies can make a meaningful difference in a way that it's quite hard for companies to necessarily make change at an environmental level without significant assistance from frameworks from governments. And I think investors working hand in hand with companies can actually make quite a significant difference in terms of benefits at a social level. So when we're thinking about engaging with companies, as well as when we're thinking about investing in companies, how companies look after their customers, how companies look after their suppliers, how companies look after their employees and other stakeholders, and how they conduct themselves in a social setting are all things which we can have impact and change over. And so I think it's just to say that this is a developing and evolving area, and one in which I think companies increasingly and investors in those companies can make a difference. And if you think about the number of people that are employed, not just in the UK, but globally by the companies which we invest in this portfolio, the ability of companies to make a real impact is significant. If you think about the number of consumers that utilize the products and services of the companies that we invest in, again, that's very, very significant. And the way that the supply chain works through the system, again, the impact that can be had is very significant. So I think just to say that this is a sort of emerging and developing area, I think there is the potential for companies and investors to work hand in hand to do, I think, a lot more and to improve the societal impact that they have. And I'm going to talk a bit through today how we think about the trust, how it works, how we incorporate our sustainable and responsible investing principles within that. So maybe if we could just skip to the next slide. This is the trust objective, and for many years, it broadly was the first 2 and a bit lines to achieve growth of income and capital from a portfolio invested mainly in companies listed or quoted in the United Kingdom. And then in July this year, we've added the last part that meets the company's sustainable and responsible investing criteria. And we'll come back to talk a bit about what that means in practice. We do have the ability to invest overseas as well. So we have about 20% of our capital invested outside of the UK, primarily in the European markets, and we would treat those companies in the same way that we would treat any other investments. Maybe you can move to the next slide. Myself and Georgina are the co-managers of the trust. We quite like having small teams, and we're backed up in terms of what we're trying to do by 2 very important sets of resource. So we have over 30 analysts or fund managers in UK, Europe, and covering small cap. So from an idea generation perspective, we're very well covered. We also have a very strong central ESG team of over 20 people that provide expertise on policy, voting, and additional engagement resource. And I think it's important to say that from an ESG perspective, that we very much have a 3-pronged approach. So we utilize the expertise in terms of company knowledge from our analysts. These people have often been working in the industry for many, many years. They know the companies extremely well, and they're in an excellent position to understand the impact and approach that companies have from a strategy and business perspective. And increasingly, I think ESG is not a separate thing. It's just part of the analysis which we're undertaking, and our analytical teams can give us real insight into the strategic impact that we can have. And then on the other side, we do have deep expertise in terms of our core central ESG team. And then within our team, we have dedicated ESG analysts who are there to provide the link with the centre and the analysts, as well as to help provide additional resource within the team. So in terms of our sort of strategy and analytical and ESG resources, we are very well positioned to be able to push this through. And just again, in terms of our overall headline numbers, the trust is just over 500 million pounds of assets. So it's a reasonably sized trust within the sector and within the equity space. We have a yield that's just a touch, I think, above the market in terms of dividend yield today, which over time we've looked to try and grow in real terms. With the discount that the trust is trading at relative to net assets is relatively tight. The charges underlying we think are reasonably reasonable, and that's a total charge number. And the management fees are I think around 30 basis points on an ongoing basis for additional assets, and the balance sheet is relatively strong. So we're just over 7% gearing. So we think it's a conservatively managed portfolio with a reasonable yield, a good total return prospects, and prospect of real growth in income. And in terms of how we're trying to manage the portfolio, it's a pretty selective strategy. We have about 40 companies within the portfolio, so it's quite a focused group. So that allows us to really get to know and understand the businesses. We typically take a very much an absolute return mindset. So we're looking to not lose money on investment. That's really one of the key elements that we're looking to do. And we have companies from across the market cap spectrum, so small caps all the way through to companies at 300 billion or so. And we have stocks within the portfolio at 300 million. So we invest right across the frame. And that's really supported by our research base, which I talked about earlier. Again, that's really a strong competitive angle for us. And we're very much focused on looking to balance dividend yield with growth and sustainability. That's really key for us. So about 5 or 6 years ago, the board took the decision to shift away from owning and being sort of tied into having to generate a very high yield on the trust, and to focus a bit more on delivering a balance of income and growth. That I think has given us a lot of flexibility in terms of how we manage the portfolio, and ultimately has allowed us to be able to adopt our SRI overlay, which for a lot of trusts would be very difficult to do, given their reliance on parts of the market such as tobacco or oil, which don't necessarily fit very well into that framework. And we have always thought very much like owners, so very engaged with the companies we invest in, very much engaging with them on strategy and governance and how they work their businesses, and that's very important to us. And the outcome of that is, quite a differentiated prospect, really. Active share for us is in the high 70s, which for a UK fund is, especially an income fund, is a high level. Relatively low turnover. We're typically taking a 5-year view. We are at the end of all of that looking to try and capture upside. And this sounds somewhat obvious, but I think it gives some idea of the strategy, which is to participate on the upside, but also to try and protect the downside. And we really want to try and produce a sort of investment journey for our investors where they feel resilient in tough times, but are able to participate in most of the upside opportunities. And it's trying to get that balance of risk-adjusted returns. And the long-term track record for the trust has been strong. And again, just to sort of pick a few elements here, and I think the things that I would go to, good exposure to the mid-small cap part of the marketplace, 35% of the portfolio, 78% tracking error. Again, active share, so 78% tracking acquired, 78% active share. So again, pretty differentiated from the marketplace. But I think the key things for me are that the consistent delivery of earnings from our portfolio over the last 3 years, on average, our portfolio has grown earnings at just under 5%. And the market has seen theirs shrink at 10% per annum. So the resilience of the companies which we're investing in has been very, very strong. I think that was borne out last year when we had the impact of COVID, where the trust saw its income only fall about 10%, when the market was perhaps around 40. So that was a real difference. The ROEs, the returns that our companies generate are better, and the balance sheets are generally stronger. And I think that goes to the fact that the companies which we're investing in, we think are very high quality businesses, and we do have that focus on holistic risk management, and that's the ESG, and particularly the awareness of risks, right in the middle of what we're thinking about, and that I think has helped us to produce something that is more resilient and has been more sustainable. And in terms of the return profile of the trust, in the last 3 months, the trust has been performing quite well. Longer term, the track record is also robust. We've lagged the market a little bit over the year, and that's really been because we've had a very, very strong year, and some of the areas where we're a little bit underweight, such as mining, some of the deeper value companies have performed very strongly over the last year as we've seen the recovery out of COVID. But I think we're starting to see the market balance out a little bit more, and over the longer term, the trust track record remains robust. And in terms of what's been driving our performance, as you can look on the right-hand side, you can see it's an underweight to, I would say, some of the stalwarts of the UK market that has caused us a little bit of performance headwind, such as being underweight some of the big oil stocks and so forth. And the things that have driven performance for us have generally been some of the sort of more differentiated positions: Intermediate Capital, UK asset manager, Sirius Real Estate, it's an owner of German industrial properties, companies like Croda, Coca-Cola, Hellenic. So again, I think it's that sort of thing of not too worried about underperformance as a result of some of these companies performing well, because I think over the long term, I think that it's unlikely that they're going to be setting the pace over the next 3 to 5 years. And so we feel pretty comfortable with what we have and how performance has been this year. And in terms of why we think over the longer term the strategy's been able to do a good job of delivering returns, and I think it's because primarily the focus is not around companies particularly exposed to UK GDP. So you hear a lot about Brexit, a lot about the underperformance of the UK market, but you've always got to remember that 75% of the revenues of the UK market come from outside of the UK. So it's always seemed a little unlikely to me that the main driver of underperformance of the UK market has been down to Brexit, given the limited amount of exposure to the domestic economy that many companies have in the UK market. That all said, we tend to look for companies that are driven by trends that are much more interesting than the UK or maybe even necessarily global GDP. So looking for companies that can be dialed into the trends and opportunities that are growing much faster than that. So perhaps we might look to something like Moonpig, the online card and gift retailer. Again, it's a market that's relatively underpenetrated. They have a very strong market share. The potential for the transition online to grow is significant, and that gives opportunities for both revenue and profit growth. And that sort of transition has got really very little to do with UK GDP. If we think about changing demographics, a business like Novo Nordisk, it's a Danish company, it's the world leader in insulin provision. Their innovative products that they've generated to tackle issues such as obesity, really make a sort of compelling long-term investment case. Again, a company that has the potential to make significant societal impact, but again, it has nothing really to do with what's going on with UK GDP. And then when we look to, say, the digitization of industry, clearly the UK doesn't have the sort of big consumer platforms that the United States has had over the last decade, but we do nonetheless have companies that have quite high levels of technological positioning, which can give them attractive longer term returns. And again, play quite an important part, particularly I think in terms of the environmental impact that a company such as ASML, which makes the machines that make microchips, can have over the longer term. So I think overall, we're looking for these sorts of dynamics that can drive attractive longer term returns that are well dialed into trends that have little to do with our underlying economic drivers. And just to say, we do have a number of overseas investments as well within the portfolio, but I won't touch too much on those. And again, I think in terms of what does that all mean at the end of it all, and we've looked at the total return dynamics, but the dividend delivery is also quite important. So we've generally looked to try and move the dividend ahead in real terms, so a little bit more than inflation. The trust has a robust level of revenue reserves, which cushion the delivery of income over the longer term. And generally speaking, we've just been looking to move the dividend ahead in real terms, and that I think is part of the overall picture for investors in the trust. So perhaps if I sort of turn to our sustainable investing approach within the portfolio and give some additional color on what that actually means in practice and how that interlinks with what we're trying to do from a total return and income generation perspective. So I think it's very much about trying to look to achieve two things, really. First of all, effective risk management, and secondly, the taking of opportunities that present themselves. So I think quite often when we think about sustainable and responsible investing, a lot of debate goes into what you're not going to invest in. And that's obviously an important part of the approach. But the way I see it is historically, we would talk to an integrated approach, and we would not invest in companies that scored poorly from what we would call an ESG quality perspective. But essentially, with the process which we have adopted since the middle of the year, we're broadly formalizing that. So essentially, we're writing into our prospectus and committing to not investing in certain types of companies, or companies have certain types of characteristics, and we'll talk a bit about some of the details around that. But very much that didn't drive huge change within our portfolio. I think we ended up changing around about 13-14% of the portfolios. So I think that should signal that we're already taking the sort of ESG risk management as a core part of what we're doing. And this is really just formalizing that from a risk perspective. So on the one hand, I see a sustainable approach as managing risk. It's looking at certain industries, certain businesses, the characteristics of certain companies and saying, these things pose significant risks to our capital. We don't want to invest in them. And different people will have different views as to whether certain companies should or shouldn't be included within that. But I think the companies which we've decided to exclude, I think there would be general agreement around those particular areas. Whether we might over time also include other areas is perhaps something that's up for debate. But in terms of the positive angle, and I think this is the important element here, we're very much looking to invest behind sort of three principal areas. First of all, looking to back companies which we consider to be sustainable leaders. So by that, we're looking for companies, first of all, which are absolutely best in class in terms of their ESG risk management. And these generally will also tend to be, it tends to very much go hand in hand with the companies which are world-class at ESG risk management also tend to be world-class businesses. That tends to go well together. Those are the companies which will own in the portfolio and will be an absolute core of driving attractive long-term returns for us. And they probably won't require too much work. A company like Novo Nordisk would absolutely be at the front of that. That's really, really, really very strong. Then we're also looking to find companies which line up, and we call them solutions companies. And these are companies that have a reasonably significant exposure to operational costs, capex, potentially perhaps revenues, exposed to areas which align with the UN Sustainable Development Goals. At Aberdeen, we take the goals and we put them into 7 pillars. And so we're looking for companies within that have they use a cutoff of around 20% exposure to those areas. And again, those are going to be companies which are tackling some of the major challenges which we have from a societal perspective. So again, I think there's a very positive story about the types of businesses which will be sitting in that area, and we'll be looking to try and make sure that the portfolio has a good allocation of businesses within that space. And then on the other side, we call them emerging leaders or improvers. These are companies where the engagement agenda for us really comes into play. So those are going to be companies where the ESG risk management is okay, but where there are significant areas for improvement. And that's where I think the combination of our ESG expertise, but also our strategy expertise can work together to drive significant change within companies. Now, that could be as simple as encouraging companies to have better disclosure that can allow people to appreciate what they're actually doing underlying. But it might also mean engaging with companies to make really significant strategic changes to their business in order to not just improve the ESG characteristics of the company, but also to drive significant improvements in value for investors as well. So we see 3 very positive angles here, as well as the risk management side, which we get from the screens and exclusions which we put in place. So, and again, sort of just to pull that together, the positive allocation of what we're trying to do. So at the core of it is a high conviction, actively managed portfolio. We're identifying the kind of companies which we want to invest in using our fundamental research base, focusing on the better quality companies within the market, and that's underpinned by that research capability. But then on the other hand, we're looking to exclude companies, and we have 3 angles that come within that. We have a series of norms-based exclusions, which if companies fail, will exclude. That makes up about 7%, I think, of the UK market. We have our own house score, which utilizes MSCI and true cost data. Again, we can't invest in the bottom decile of companies within that area. And then we also have our own quality score, our ESG quality score from our analysts. And again, if companies score poorly on that, then we won't invest in them either. And together, that probably rules out about 25% of the market, which is excluded. But I would just say, we're very selective. So the companies which are actually entering into our investment universe in the first place have already been heavily screened. So we're probably only looking at maybe 100 companies out of the FTSE 350 plus the European opportunities that which we might have anyway. So we're already being very selective, and this just gives an additional lens for exclusion.
Just while we're talking about this, then we've just had a question come through. How do you measure your own progress on ESG issues within the portfolio?
Yeah, I think that's a really great question. So I would say that is something which is which we're working to develop at the moment. But essentially, maybe if I put it into context, we have an engagement agenda. So for each company, we have a set of criteria which we set out, and then we decide, what are going to be the key areas for investment? How are we going to invest in those businesses? And the ability to be able to identify those is key. So we sort of sit back at the start of the year, look at all the potential opportunities which we might have within the portfolio, identify the key areas. Those are typically going to be the companies that are scoring poorly, and then identify the areas why they're scoring poorly, and then we set those out, and then we'll set out over the course of the year to attempt to remedy those. And we essentially track those. We track the development of those issues. So we'll say these ones over here are the most serious. These are the things which we need to be able to develop, and we track them through initiation all the way through, hopefully, to conclusion. And that's a process which we're sort of refining at the moment. But hopefully, and we're probably not quite at that stage yet, but we should be able to take and show you all of the companies within the portfolio, all of the key issues that they have, and where we are at each stage of that engagement process, and hopefully running through to conclusion. And that's the kind of level which we're aiming for. And I think if we were able to do that, then I think that would be quite a compelling story to be able to tell our investors.
Brilliant, thank you. I'll just carry on the presentation there.
Yeah, I'll just touch to the next bit. And why do we think this is important? Well, I mean, we can see that these companies have the capacity to generate better returns, lower volatility, and ultimately outperform. And I think we've seen companies that can adhere to and score well on ESG elements are doing better in recent years. I think if you go back a decade ago, I think investors often had to feel they had to contend with weaker returns in order to invest sustainably. I think now today we absolutely know that that's not the case. Now, it might well be the fact that some of the performance has come from some of the sectors that happen to score well from an ESG perspective, like perhaps technology. But I think we also know that there are as much areas which score poorly, which are have become very, very difficult for investors to invest in. And I think as more and more investors have been unable to invest in some of these areas, then that has driven underperformance. So I think it's as much about avoiding the companies which are going to underperform as investing in the companies which can also outperform as well. And again, what do we mean by this sort of sustainable leaders? Well, they're very much the companies which have very strong market positions, but these are the companies which are proactive, which are engaging strongly with their stakeholders, which really manage their risks and have very low exposure to ESG controversies. And I think it's essentially where you've really got a really nice symbiosis between their ESG risk management and their core strategy. And when you see companies working really well with that, with great transparency and disclosure, then that's I think very, very positive for us to be able to identify. And again, again, in terms of the sort of solutions providers, again, we certainly have seen increasing opportunities for companies that are well aligned to the SDGs. And again, I think that's going to be something going forward where we can find companies that are going to be well positioned in that area and potentially can deliver again attractive levels of growth as a result. And certainly we're seeing opportunities across the marketplace for companies where strong alignment to these areas that are growing quickly is proving very helpful to those companies, and that's something which we'll be looking to expand within the portfolio. And then finally, these I think we see are the opportunities to find the companies which are improving. So we see the returns that can be generated from companies that are seeing their ESG ratings improve. There is a positive correlation between those things. So an active engagement strategy can drive value, we think, as well. There's just a few examples of companies here which we think kind of sort of illustrate those areas. So I think, first of all, Croda, which a UK specialty chemicals company, an absolute global leader in terms of providing the sort of specialty chemicals that can really help companies, improve themselves. And again, very, very strong ESG profile. Marshall's is interesting as a solution provider. Essentially it makes sort of street furniture, but again, they're really developing ways to be able to do that are much less carbon intensive or even carbon absorbing than they have done in the past. And again, sort of an interesting, not necessarily an obvious solution provider, but something which again we quite like. And then Genus is a business where it hasn't historically scored particularly well for us in terms of some of its ESG characteristics, but where there's the opportunity for us to engage and improve. And there's certainly been a really active engagement there to help them improve their disclosure, which again is quite often key to helping people understand how companies actually manage themselves.
You've named a few companies there. We've got a question about another one of your holdings, BHP. Have you engaged on risks with them, such as the Samarco dam disaster in Brazil?
Yeah, I mean, we don't own BHP anymore within the portfolio. So as part of the implementation of the SRI criteria, then BHP was sold, and that was primarily because of its some of its hydrocarbon exposure didn't meet our criteria. So absolutely. I mean, just to say about Samarco Dam, I mean, when we did have it as an investment within the portfolio, we were active in terms of engaging with the company around that. Again, that was a very unfortunate accident, and again, I think from an investor perspective, those are sometimes quite difficult things to understand in terms of responsibility and who was at fault for those sorts of things. But as I say, from today, that's not a company which we currently have. It would also be worth saying that Rio Tinto was also sold as part of our process, not because of its environmental profile, but because of its governance profile. And as you'd probably be aware, the company had been dogged by a number of issues relating to everything from investments in Mongolia, coal mines in, I think it was in Mozambique, and then also issues around the treatment of Aboriginal remains as well in Australia. And I think we felt that the company's ESG risk management, and particularly at the governance level, didn't fit with what we were looking for. And so at this time, it was graded at a level where we couldn't invest in it, and we had to divest.
Just to follow up to that question, these kinds of risks maybe not as extreme in that case, but what is the response? Is it to sell, or are you activist and influential?
Yeah, I think it's always a balance. I don't think it's a choice between engagement or divestment. I think it's about being realistic about what you can achieve, and whether or not it's credible. I think if you're engaging to encourage a company to completely change its entire business model, that's probably, I think, to the optimistic end of the spectrum. If you're engaging to drive clear, specific changes that you think are actually realistically achievable, then I think engagement is an option, and I think that would be where I would draw the line. Really, I think, of course, I mean, the energy transition is a highly complex thing, for example, but I think that there is an element of importance in terms of saying, no, we won't do this because this company just isn't anywhere near where it needs to be. When there's a bit of a difference between joining a company that's already making significant changes in the transition, and where we can say yes, and we can look forward and say in 5 years this company is going to have, I don't know, 75% of its revenues not coming from oil, for example, just as a hypothetical. So I think it's about where change is realistically achievable. We can have clear aims and goals, and I think ultimately we have to be able to sit in front of our investors and say, this is why we have this in the portfolio, this is how we're thinking about it, and hopefully that makes sense to them, and hopefully that makes sense to us. And if we can't justify it, then that's ultimately going to be our problem.
Sure. So do you look at the ESG impact of every portfolio decision that you make?
I suppose in a way, yes. I mean, we monitor the overall score for the portfolios in terms of our internal scores. We look at the external gradings that the companies get. We look at the carbon footprint the portfolio has. So I wouldn't say that sort of every small move we're looking to see what the change in balance is, but absolutely, it's a consideration when we're introducing companies or exiting companies. What's that doing to the overall profile for the trust? Absolutely.
Sure, thank you. And we've got quite a few questions coming in now. So should we sort of move on?
Yes, let's just do questions. Yeah, that's great.
So how frequently do you or will the board review the trust policies on sustainable investment?
Yeah, so we only made the changes in July for the first time. So that has been put in place. So they've only been in place for a few months. But I think what we will be looking to try and do is to evolve those in line with best practice. So I know that what we did do was we took principles which we've utilised in the sustainable responsible investing range of other Aberdeen funds, and I know that those are also evolving and developing. We've got a series of changes that we're putting in place in our wider range as well, and I think it's partly because best practice is evolving quite fast in this area. So levels of exposure that people previously thought were acceptable, those ranges are tightening. So I expect us to probably do an annual review as to where our positioning is, and to some extent it's easier for us to make those changes than it is necessarily in a standard fund range, because we can just change them ourselves within the trust, and we can make that happen. We don't have to go through a long legal process of altering fund range documents. So we have perhaps a little bit more flexibility. And if you think about the investment objective of the trust, that is a fairly broad thing. The details that underpin that, it's easier for us to be able to change those.
Sure, thank you. And what proportion of the portfolio do you consider to be really strong on sustainability? And on the other side, what proportion would you say you're looking for improvement on?
Yeah, it probably breaks down to about a third, I would say, in terms of our exposure in that way. I think we actually have a slide on page 24, I think, that might just give a bit of colour on that. If we skip forward a couple more, maybe. Keep another one, maybe one more, and another one. Yeah, there we go. So this is our view as to how the trust sort of sits there. So we've got about 40% in companies which we think can, have got scope to improve. And I think an ideal balance is probably, maybe 20 to 25% in improvers probably over time. And then a nice balance between leaders and solutions providers. Solutions providers is probably going to be, I think those are rarer, those types of companies. But perhaps something in the order of sort of 25, 50 might be a reasonable ambition over time.
Can you talk a bit more about how Diageo fits into your sustainability framework?
Yeah, absolutely. I mean, we don't exclude alcohol within our current set of principles. We have thought about that. I think ultimately, I think the board were keen, in terms of the way that they put the principles in place, were to not make too many ethical judgments in terms of decisions. That they were very keen to put decisions in there around the environmental impact, and I think they felt a bit more uncomfortable about making too many ethical choices. They're okay with weapons and tobacco, but I think when it came to alcohol, I think they still felt that there were reasonable reasons to include that within this portfolio. I think it's important on our part to make sure that we're engaging with the company, to make sure that the Diageo's principles and marketing and distribution and sales that they have, that they're running that to high standards, and that they're not just meeting legal obligations, but doing more than that, encouraging them to continue to accelerate their development of low and no alcohol products. But yes, I think there is a question mark around that over the long term. How does their strategy evolve and develop? What will society's reaction be to alcohol? Absolutely. And I think it's one of the challenges with the SRI is that there will always be some companies which don't necessarily fit with different people's views as to what is acceptable and what isn't. And I think we can only explain this is how we're thinking about it, and not say this is the right way or the wrong way, but just say this is how we're currently doing it, except that there might be different views as well. So that's sort of how we consider that. I think economically, from a Diageo perspective, there is a bit of a difference, I think, with, say, the tobacco industry, in that I think the impact of harm is probably less, but secondly, you've got a situation where the profitability of low and no alcohol is. Sure. Sorry. You sit well. So the situation with Diageo is very much the case that their profitability of the low and no alcohol assets are as profitable as anything else. which perhaps even more profitable. So the incentive to move the business in that direction is also quite
high. So obviously very topical at the moment, climate change, COP26. What were your key takeaways as a house from COP26?
I think very much a situation where progress has been made, but there's a lot more to do, and that's again, I think underlines that if you want to get significant environmental change to happen, you do need significant government intervention to drive that and create the right frameworks and incentives. And again, that there's a very difficult combination of politics and economics to be managed to be able to deliver that with a host of different incentives and different views. So that's my main takeaway. I don't think there was anything necessarily hugely surprising that came out of it, to be honest. I think what was achieved was a framework. The language around it is always tortuously difficult, and we'll just have to see how countries develop on it. But it wouldn't surprise me if the momentum and pace of change isn't continuing to accelerate at an exponential pace. And might it be that next time that we're sort of sitting around for one of the major global environmental conferences that that we end up with making more accelerated progress. But I think at this stage we have to settle for what we have. But I think for all the talk about last chance saloons, I think yes, that's probably true. But I think also change is also accelerating fast, and so the direction of travel when we come to the next time might also be moving in a different way.
Sure, thank you. I think we've got time for maybe one or two, sort of veering off the sustainability angle. How might the fund perform in a rising interest rate environment?
Yeah, how will the trust perform in that environment? Yeah, I think it sort of depends, really. I mean, we feel quite well balanced within the trust. There's a range of different exposures. So we have a fairly hefty exposure to financials. So in general terms, I suspect that those would fare reasonably well. We have exposure to perhaps pharmaceuticals and consumer goods, which may find a rising interest rate environment a little bit more difficult. But overall, I'm not too concerned about that sort of dynamic. I think the market overall can tolerate interest rates moving upwards in a reasonably healthy way. I mean, I think if I look at the US market from 2010 to 2019, the market was able to grow very well as the Federal Reserve grew interest rates from sort of 0 to around high 2s, 3%. So I think a generally raising interest rate environment isn't necessarily a particularly concerning thing for me.
And just on that note, final question: what are you most concerned about going into 2022? Maybe what's the sort of key worry?
Yeah, I think it's probably more that we start to see the global economy slow. I think that's probably more my concern that we see it than we see overheating, and we sort of see some of the global trends start to move in a negative direction. And that I think as the sort of burst of stimulus gradually fades and the faster growth which we've experienced sort of annualizing very weak periods starts to move on, then perhaps we're sitting in a situation where the outlook for growth is starting to weaken. And then what are the policy levers that we have available to us, having been through a period of time where we've deployed pretty much every trick in the book to try and keep things going, and government balance sheets are fairly stretched, and interest rates and monetary policy is fairly low. So those would be the areas and things that I would be most concerned about. But again, I'm not saying that that's a sort of a certainty at all. But I think that's something to look for. I think I think 2022 is probably a year where where the economy is probably okay, and that's probably okay. I mean, we certainly see it more as a sort of earnings type market, really, where companies that can generate good earnings will probably do quite well, and those that don't won't. And that probably also means it's not necessarily particularly a style-driven market in 2022. But as ever, I think it's more around thinking, what are the potential risks, what are the probabilities? There are some risks out there. There are not negligible percentages that those bad things could happen. But I think the central case would be for something that's okay next year.
Brilliant. Thank you very much. Time's absolutely flown by there. Yeah, thank you so much for your time, Ben. Really interesting. Look forward to see how things go going forward.
Brilliant. Thank you very much. Much appreciated.
Cheers. So we have our next guest with us today, Paul Bridge from Civitas Social Housing.